Okay, class, in this video, we're going to take a look at this Form 1065, which is the partnership income tax return for the year. Now, before we look at the specific fields and schedules on this form, we have to ask ourselves, where are the numbers coming from to fill in this form? And basically what you got to do is go back to your previous accounting classes where you had learned to prepare a company's financial statements. So if you remember, the first one we usually prepare is the company's profit or loss or income statement. And then we also have the assets, liabilities, and equity showing up on a company's balance sheet. And then where the money is coming from and where is the money going to, a statement of cash flow, and some type of analysis of the company's equity, stockholders' equity, or maybe the company's retained earnings. So these financial reports, these financial statements would be presented to people interested in the financial condition and profitability of our company. But these are not income tax returns. So something even maybe more basic than those financial statements or the company's trial balance. So if you remember a two-column trial balance where we have debit balances and credit balances. In one column would be the assets with debit balances. So here's everything the company owns, specific assets. Then in the credit column, we would show liabilities owed to creditors. And then also probably in the credit column would be the capital or owner's equity, showing the interest of the owners in the company, in our case now partners in a partnership. And then all the different ways of making money, the revenue accounts, and then the costs incurred to make that money. The expense accounts in the debit column. Again, your debit balances have to equal your credit balances, although I just show everything in one column here. And then at the end of the year, you would update these balances to make sure they're current. In our case now, specifically updating them for tax rules. So all the balances here, especially the revenue expenses, have applied the tax rules we've been learning in the past couple of videos. And now we're going to group this revenue and expenses into two different broad categories. In one category, we'll call that ordinary business income or loss. Okay, so we'll take most of the operating revenue and put it into this column for ordinary business income or loss. And then most of the related expenses for operations, we would deduct it to get that net income or net loss for our operations. Again, ordinary income or loss. Now this is not all the revenue and expenses. So other revenue that's not included here, other expenses not included here. We're going to move them into a second category called separately stated, I'll just call it separate items here. So other revenue, other expenses. And then we don't really take a net down here like we do over here because each one of these items are going to be separately reported eventually to our partners. In the case of this net income or loss figure for ordinary business operations, we're going to just give them this one figure and not the detailed revenue or the detailed expenses here. And then, of course, here's our balance sheet accounts that eventually will go on to the partnership return. We're probably also going to take maybe, let's say, the drawings, the distributions from the capital section and put it also into separately stated items. even liabilities where it have an effect on the partner's basis may be separately stated to each partner. Okay, so again, the key numbers here for tax purposes is this ordinary business income or loss figure down here, and all the different separately stated items in this column, and everything coming from the company's trial balance as adjusted for tax adjustments. So let's go back to the 1065 form, and this is the first of 5 pages. Here is the 2019 version of the form, and so for most taxpayers, like you and I individuals, if we're in a partnership and we own the majority interest, the partnership has to adopt the same tax year. So most of partnerships have individual owners would use the 2019 calendar year and not a physical year here. Now, if you have corporate partners that have physical years and they're the majority owner, you probably would fill in the physical year here matching that partner's majority partner's year end. And if their year begins in 2019, you use the 2019 form, even though their year end would be probably in 2020 for a physical year partner and partnership. So you identify the partner's information over here, name, address, and so forth. If it's a new partnership or any partnership, you have to put the date of the started business. And if it's new, you would check off this initial return. If this is the last year where you're probably liquidating, where there's special rules in liquidation distributions, you would check off this final return here. Cash or accrual, maybe hybrid methods. We've talked about that in previous chapters. More and more taxpayers are now more eligible for the cash basis, the simpler cash basis. Here in question I, it asks you, how many partners are there in this partnership? And for each partner, you gotta attach to this return a Schedule K1. And a copy of that partner's K1 would go to that partner, so they would know how much income and expenses they can claim on their return. So the income, first let's read this message here. Caution, include only trade or business income and expenses here on this first page line 1 through 22. And that's here from our trial balance, this ordinary business income and loss section. Okay, this is what goes on page 1 of the 1065, your main operations. So basic type of income would be sales or fees you charge, minusing out any cost of goods sold calculated on this separate form here. We know that's the beginning inventory plus purchases minus ending inventory to get the company's gross profit, plus other income, possibly from other partnerships, which our partnership is a partner in. Some miscellaneous income here to get the total income. And then the partnership's operating expenses. Again, the ones that are calculating all the way down to this ordinary business income or loss, not the separately stated income or separately stated deductions. Let me point out a couple specific deductions here. Partners cannot be employees of their own business. So when you pay a partner a monthly fee, it's not a salary or wage you put here in line 9. But that type of payment is called a guaranteed payment paid to a partner. And it shows up as a deduction. But again, this is not a salary or wage being paid to a partner. It's the tax term is called guaranteed payment, and it shows up as a deduction for the whole partnership here in line 10. But which partner that receives this guaranteed payment, they gotta report that whole guaranteed payment on their individual return as taxable income. But again, then it's being deducted here by the whole partnership. So then we total up our deductions, subtract it out from our income here to again get this ordinary business income or loss that we now going to report on another schedule. I believe it's on page 4. Here, the top of page 4 on a schedule called K1. Here, line 1 is that same ordinary business income or loss on that line 22 from that first page. This Schedule K are all the different amounts that we're going to be reporting to the partners. So now the partners can know how much they have to pay taxes on or deductions they can claim on their individual return. And the main number is this line 1. But then other types of income may be taxed differently than this ordinary business income based upon the circumstances of that partner's individual return. So stuff like rental income or losses. We've seen in previous chapters, it may be subject to passive loss limitations, so that may be separately stated. Here's that guaranteed payment item again, but this time it's going to be reported not as a deduction, which is already subtracted to get this ordinary business income, but here is the amount now the partner has to report as income based upon, say, the services provided by that partner to the partnership, or investments or property lent to the partnership by that partner. Again, this is compensation that partners have to report as income on their own individual returns. Interest income and dividend income, so-called investment income, again has special characteristics on the partner's return, and that's why we separately state them here as compared to grouping it back here in the ordinary business income. For example, we know qualified dividends get taxed at lower rates than the marginal rates for the partners. Same goes with capital gains and losses, be they collectible at 28 or unrecaptured max at 25, or possibly treated as ordinary income under 1231 rules, or capital gains under 1231. So that's income. And same thing goes for deductions. We have to separately state them because there's special limitations at the partner level and not just here in the partnership level. For example, Section 179 depreciation deductions we learned about in a previous chapter has both income and dollar limitations that apply at the partner level. So here's the amount of deduction now the partner has to use and calculate their own limitation on their individual return. Likewise, contributions maybe are subject to 60% limitation of the partner's AGI. Self-employment income is an important figure because not only is the partner subject to income taxes, the partner may also be subject to self-employment taxes based upon what's put here in line 14. And then business credits are going to be allocated among the partners. Other miscellaneous information, a lot of this is foreign disclosure. Here, this income that's not taxable and expenses that are not deductible still have to be reported because it has an effect on the partner's basis, even though they're not taxable or not deductible. Line 19 is important because this is the amount that was paid not as guaranteed payments to the partner, but as distributions or withdrawals by the partners from the partnership. And it's going to be usually tax-free to the extent of the partner's basis, but it's going to reduce that basis for whatever they took out. Okay, so all of this Schedule K is for the whole partnership that has to now be allocated among the partners. So now the way you communicate what has to be paid or allocated to each partner is to prepare another schedule called a K1. So here is the name of the partnership, and here's a specific partner that you're reporting to. And this column from line 1 through line 20 something, it basically mirrors the fields back on Schedule K, but only now you're filling in here the amount that goes to this specific partner. There's also an analysis down here of showing a reconciliation, and we saw this in a previous video, how to calculate the partner's inside basis, the beginning basis plus contributions minus withdrawals plus or minus the share of that partner's income for the year. And then here is the amount of the partner's liabilities, be they recourse or non-recourse. And here is a percentage of the partner's share in the profits or the loss, or even if they liquidate, what's the amount they can claim out of the whole company, the capital interest. Okay, some other disclosures, the type of partner they are. Okay, again, this goes to the partner and a copy attached to the 1065 and filed with the IRS. Let's go back to the 1065 form. Again, we just saw the K1 related to the Schedule K. So there's lots of questions the form has over here. Well, let's first go back to the questions on page 2. Things like what type of entity, and we talked about this in a previous video. In this case, domestic means US, not just from a specific state. And outside of the US would be a foreign type of partnership. Here we're disclosing who are the owners, and if they have more than 50% interest in the partnership, you may need to prepare a Schedule B1. Yeah, a Schedule B1 and attach it to this form, text 1065. Or maybe our partnership is a partner in another partnership. So that has to be disclosed over here, listing out the name of the partnership or the name of the corporation in which our partnership is a shareholder. Again, a lot of the questions here deal with foreign disclosures, dealing with disclosures about being a tax shelter, showing the owner's interests, possible conflicts between the partnership and their interests. And again, here's the Schedule K. Let's take a look at the next page. At the top of this page 5, this last page, is allocation among the total income. In other words, all the income, both the ordinary business income and separately stated items are totaled up here in this line 1. And then how it's allocated among the different types of partners based upon the type of entity they are. Okay, so this is just a reconciliation of allocating the total profit or loss among all the partners. And then, of course, our balance sheet, both for the end of the year and the beginning of the current year. So we have 4 columns here. Basically, this first column A and C is just grouping stuff to put into column B. It's not a debit or credit column. For example, here is the accounts receivable minus the allowance for doubtful accounts equals the realizable value here that you're grouping together in the second column. Likewise, cost of depreciable assets less the accumulated depreciation equals the book value for those assets. And here is the total asset lines. We know assets are equal to the liabilities plus the equity. In the case of the liabilities, that's this line 15 all the way down to line 20. And the capital equity is just this partner capital account totals here in line 21. But the capital accounts is reconciled down here in this Schedule M2. So this beginning capital here, beginning of the year, should be here in the first line 1 of Schedule M2. And the ending capital should be the last line of Schedule M2. And everything in between this line 1 and line 9 shows you the changes during the year. So this left-hand column is basically things that will increase the capital account, except unless you have a loss, yeah, for net income or net loss would be subtracted out here. And the right-hand column will be everything that reduces the capital to get the capital at the end of the year that shows up here in this line. Again, the beginning would be over here at the beginning of Schedule M2. This Schedule M1 is a reconciliation, Reconciliation is just a report showing differences from one number to another number, one balance to another balance. So here's your net income coming from your financial statement. And you have to reconcile it all the way down to this number here, which is the taxable income for the whole year. And it matches the number way up here. Remember, this is the total income and expenses on the tax return. Again, that's way down here. And here is the net income from your financial statement. So stuff that will increase this number up to the taxable income is going to be added in this section. Stuff that decreases the taxable income shows up on the right-hand column. Again, if your company's books, the company's records are based upon tax rules, then this number should probably automatically equal this number with no reconciling items in between. I think we're going to have a tax return project with that situation to keep things simple. Okay, that's it for this Form 1065 and the related Schedule 1. Make sure to email me if you guys have questions. Okay, otherwise, talk to you later.